What's up, guys? It's Charlie FX here, and today I got quite a few requests to make a beginner's guide to Forex, since lots of you haven't really gotten into trading or don't know all the terminology that I was using. So here we go. So the basics are, when you open a chart, you're going to be using Japanese candlesticks. So this, as we can see, is this candle's red. So it opened here and it closed over here. So here was your opening price and here was your closing price. So price fell. And this part between the open and the closing price is called the body of the candle. And this over here is the high of the candle, the wick upwards. So what that means is price opened over here, then it moved all the way up. So initially this candle was moving upwards. Then it fell down past the open, all the way down here to the low, and then it pulled back and it closed over here. So that is a body. And then this candle is an upward candle that opened here. It initially fell to the low, and then it proceeded to rise all the way up to the high, and then it closed over here. So that's basically candlesticks. And you should use candlesticks to trade instead of line charts or bar charts or whatever, because it gives you a lot more insight into the market to see what is happening. You can see where the highs were, where the lows were, and if there was indecision in the market. Okay, so these are the only candlesticks you need to know. Please, guys, don't go and study candlestick patterns or reversal patterns. You're only going to lose money. Do you really think traders could make money by studying a few patterns on a chart? It's like, honestly, no. Imagine you're working at a hedge fund controlling millions of dollars, and you tell your manager, okay, I see a pattern on a chart. Okay, I'm going to sell $1 billion worth of currency. No, it doesn't work like that. So if it was that easy, everybody would be rich. So these candles are basically just going to tell us, is there indecision in the market, is there selling pressure or whatever. So we can see this candle, it's a bullish candle. It's green. Bullish means that it's going upwards. And this candle rose all the way up here and then fell down and closed here, and obviously opened here. So what does it tell us? It tells us there's selling pressure in the market. The market tried to rise, but then sellers took over and pushed the market down. So this is the exact same candle, except that it opened over here and closed over here, but it also rose all the way up and came down. That's just telling us, okay, there's selling pressure in the market. We should be wary if we are in a buy position. And so this could happen in an uptrend or a downtrend, just telling us, okay, there is some or a lot of selling pressure. Now, what this is a bullish engulfing candle. And we have a downward candle, a selling candle, and this candle's price action, this whole movement of this candle is engulfed by buying. And that's quite a good indication that the market has strength to proceed upwards. And here we have the exact same thing, except we are having a bearish engulfing candle, and that is just the upward price action is being engulfed by selling pressure. And that's also quite a good sign that the market is, if it's in an uptrend, that it's losing strength, and that you could start looking for selling opportunities. And obviously if these were reversed, so you would have this thing just flipped, then that would indicate that there is buying pressure. So the price would fall down all the way and then be pushed back up. And this is honestly the only candlestick patterns you need to know. Well, they're not really patterns, but just you need to understand that. Okay, so in Forex, what does it mean when you buy and sell? So let's take the Euro USD currency, for example. So let's say the price is 1.1258, whatever. And this is a price. So 1 euro is worth 1.12580 USD. So that means when you buy euros, you're paying 1.12580 USD per euro. So when you sell, that means that you sold euros and you bought US dollars, thinking that the euro will lose value against the dollar. Okay? So now when you buy Euro USD, that means you sell dollars and buy euros, thinking that the euro will gain value against the USD. And obviously the difference between the price that you sell and when you close your position, the difference in price is your profit. And that's basically it. So what is a pip? So when people speak about Forex, talk about Forex, they're always speaking about pips. And a pip is a percentage in price. So 1 pip is equal to a 0.0001% change in price. So a standard lot is 100,000 units of the base currency. Therefore, when you're trading one lot of a currency, each pip is worth 100 times 0.0001, which is equal to 10. So if you're trading Euro USD or any USD pair, you can just have in your mind that a pip is worth about $10. So therefore, if you're trading with one lot and you catch a 50 pip trade, you'll make $500. But also, if you're trading with a lot and it goes 50 pips in the opposite direction, you lose $500. So leverage. Leverage is the money that your broker lends you to trade with. They give it to you on margin, basically. So if you have an account with a broker that offers you 1 to 500 leverage, it means that for every dollar you deposit, they will give you $500 to trade with. If you have $1,000 in your account, you can open a trade worth 500,000 US dollars. So 500,000 US dollars, one lot is 100,000 US dollars. You can open a position, a 5-lot position. So now we have to be wary about over leveraging. So if you open a 5-lot trade, each pip is now worth $50. So if one lot, it's $10 per pip. Now you have 5 lots, so each pip is going to either make you or lose you $50. So that means if the trade moves only 20 pips in the wrong direction, and that happens a lot, even if you get the call right, it might just move 20 or 30 pips down and then rocket up. That 20 pips will blow your account. So you have to be very wary about using leverage. Well, such high leverage. Okay, so in Forex, a lot of times you've probably heard about the spread. So this is a difference between the bid and the ask price. So the bid price is the price that you sell the base currency at. And the ask price is the ask price is the way you buy the currency back from your broker, or the broker buys it from you. So the difference between the bid and the ask is a spread. So let's say there's a 2 pip difference. So over here we see there is a 1 pip difference. So that means when you open your position, you will immediately be in a 1 pip loss. So if you're using a lot, you would have been $10 in loss. So okay, well actually I didn't look at the mini pip there. So you would actually be in $3 loss. So the spread is only 0.3, but that's a very low spread. If you let me actually go to a Forex time account. They are really terrible brokers, and then you can actually see what a realistic spread would be on a currency pair. Yeah, it's taking a second to open now. But yeah, it's quite important that you choose a good broker, because you don't want to be paying when you enter a position. See, there's a realistic spread of about 2 pips. But some different currency pairs have different spreads. So if you look at JPY, you see it's got an Australian dollar, Japanese yen. You see it as a 3 pip spread. So when you open a 1-lot trade, you're immediately in a loss of $30. So that's quite important to think about, especially if you're scalping. Okay, so you get different type of order executions. So market execution, so when you click buy or sell, the trade is immediately performed. So you're in the market immediately. Now you get orders. So the first one is a buy limit. So price must fall to a certain point where you put your buy limit in at that price, and then a trade that you place will open as a buy. Now a sell limit, price must climb a certain amount, and then the trade that you place will open when the price reaches your order price, and it will open a sell position. A buy stop, an order placed above price, and when that price is reached, a buy position will be opened. And then a sell stop, an order below current price, and when price falls to your order price, a sell position will be opened. So basically, you would place a buy stop or a buy limit if you are maybe looking for a breakout or reversal in a trend or whatever. So that's just you kind of speculating a bit. So the different types of trades. So you'll see quickly, like type in Forex on YouTube, you'll see people selling you different, or teaching you different trading methods. There's quite a few. So the main ones are scalping. So it's normally on smaller time frames like the 5 minute, the 15 minutes. It could be on the daily, but most scalpers use small time frames, 5 minute, 15 minutes, etc. So you get in and out of the market quite quickly, just making a couple of pips. So small positions. So swing trading, you look for bigger movements in the market. So when the market reverses at a pivot point like a double top, you would sell or whatever. And then you get a trend trader, traders who wait for a trend to develop and take a position in the direction of the trend. They normally hold their positions for much longer, and then you get position traders. So I don't understand it completely, and it's irrelevant. Well, I do understand it because it's just people who invest in Forex basically. So if you look at the economics in South Africa and you see, okay, the rand's going to do terribly in the next few years, you would buy dollars and sell rands and then hold that position for long. So they're investors in Forex, not traders. It's not what we do. Okay, you get different market phases. So all markets go through phases. The keys are to identify them and then trade accordingly to what phase you're in. So the first one you're going to be looking at is consolidation. Markets spend about 70% of time in consolidation. So the market is trading within a range. So this is where swing traders thrive, but they mostly lose money like 90% of traders. So what you can see here is market is in this quite tight range, and what's happening is it will reach a bottom, which people refer to as support, and then go up and reach a top, which people refer to as resistance. And as you can see, price is being supported by this level, and price cannot break through this level. So this is called support, and this is called resistance. I don't think so. Lots of people trade using support and resistance, but I wouldn't recommend that. Also, so a swing trader would wait for price to reach this area, touch it again, then they would sell from this area because clearly it's been acting as resistance. But the problem is you don't know when this is going to happen, and that's why this doesn't work out too much. Okay, so the trending market. So the market is moving in a clear direction. In an uptrend, the price is rising with a series of higher highs and lower low. Higher high, lower low, higher high, lower low, higher high, lower low. Well, this is a higher low, but that's called a break of structure, but the market did recover and continue in the uptrend. And then in a downtrend, price is falling, and we have lower highs and lower lows, and that continues in the downtrend. Okay, so the markets are only in a trend about 30% of the time, and the other, okay, I wrote 80% here, but that should be 70%. 70% of the time, they are in consolidation. Okay, and that's about it. So next video, I'm going to release one of my scalping methods, and I'll basically teach you how I trade during the day. And it's actually quite fun. It's interesting. The market's always moving, and we only trade in the London session and the New York session. So in Forex, different countries run the Forex markets different times of the day, basically, because it's a 24-hour market. So I think it's 8 o'clock South African time. The London session opens, and then after that it's a New York session, and then it's an Asian session. We don't trade in the Asian session. The markets are quite slow, spend a lot of time in consolidation, and we don't like that. Okay, so that's basically the video. Thank you very much for watching. I appreciate it.